Good afternoon. Welcome to the Tax Saving webinar that's part of our Exit Strategy series that Sunbelt Business Advisors offering to our clients. This webcast presentations, they're here to really inform business owners so that when the time is right for you to move on to your next venture, or if you plan to retire, you're going to be well positioned to minimize taxes and maximize what you walk away with at closing. I'm Joan Young, the president of Sunbelt Business Advisors, and I'm joined by Eric Nielsen, our senior business advisor with Sunbelt, who will be on the panel to help with questions. Today's guest speaker is Pam Hedblad with Abbott, Stringham & Lynch of San Jose. Pam is a tax specialist with 29 years experience working with small to mid-sized companies. Pam's on the webinar today to answer some of the questions that I know are on most of your minds. I'm going to be asking Pam questions throughout the webinar, and I'm going to leave 10 minutes for Q&A at the end. So if you'll notice on the screen, you can enter your questions in that chat box on the bottom left-hand corner of your screen, and we're going to cover as many of those questions as we can in the allotted time, but we will end our webinar at 3:45. So if you didn't get your questions, if we didn't get to your questions, we will have on the last slide how to get in touch with Pam, Eric, or myself. Okay? All right, let's go to the first slide. The question is, what do I need to know about taxes? And I think the first point that I'm going to cover is strategy conquers all. So the opposite of having a strategy would be, for example, if you just wake up one morning and say, I have had a horrible week, I'm out of here. And you decide to put your business on the market. That is not the best way to garner the most for your business. It does take some strategizing. And the timing and planning of your exit it's really key. And the more time you allot, the better, you're just going to be able to implement your strategy in a better way. How much time is needed? I would say at least a year, and some tax specialists may say up to 3 years. So how do you get top dollar for your company after taxes? This is basically the ultimate goal for sellers. Some sellers are focusing on the wrong thing. Some of them are focusing on how much cash am I going to get at the closing table, where it should really be how much you're going to walk away with at the end of the day, meaning pre-tax dollars. And Pam is going to go into a lot of that today. And then, of course, Pam's going to touch on the corporate structure and how that matters. For some of you, it is what it is, and it may be too late. But Pam's going to show you how some of you are going to be able to change it to benefit tax-wise when you sell your business. Hiring a tax expert. This is probably the most important thing you need to know about taxes, is having a tax expert. Because if you don't work with an advisor or strategist, the more you're going to be paying to Uncle Sam. So the more time you have to plan and implement those strategies, the more money you're going to have. So, Pam, welcome.
Thank you. I'm glad to be here. Thanks, Joan. I appreciate the opportunity.
Good. Well, I want you to, if you could, is just tell us how the sale of assets are taxed differently in a C Corp versus an S Corp, and really what's the main difference?
Well, I'll tell you, this is the classic struggle between buyers and sellers. Sellers typically want to sell their stock because there's capital gains treatment that you get when you sell stock in a corporation. Could be, a publicly held company or your private company. It's treated the same way on your tax return when you sell stock. So the seller wants to sell stock, but the buyer wants to buy assets. And the reason for that is they want to be able to deduct as much of their purchase price as possible. So they want to allocate it to fixed assets that they can depreciate, or intangible assets that they can amortize. So they're looking for the biggest write-off for them.
Okay.
So it creates a challenge, and that's part of the whole negotiation process. The other reason is they might want to cherry pick the assets. They might want some of them, but they don't want all of them. And that also goes along with trying to avoid liabilities. So typically, if a buyer is buying a company, say it's a manufacturing company, for example, they're probably going to take the accounts payable and the accrued vacation and the accrued payroll and the things that are like day-to-day liabilities, but they don't want to take liabilities that they don't know about, like environmental liabilities or warranties that haven't been accrued. And so they're trying to avoid liabilities that are unknown, and that's the other reason for cherry-picking assets and not buying the stock.
Okay. Pam, we heard from somebody that they can't hear, and I was just wondering if you could, are you on speaker or are you on headset?
Well, I'm on a headset, so let me try holding it closer to my mouth. Is that better?
Wes, can you let us know by writing in whether that's better?
So I'll keep watching that.
Okay, good.
And so the other item that we've got here is converting from a C corporation to an S corporation. And probably most business owners understand the distinction, but let me just go over it briefly. So a C corporation, so I haven't done anything different. I don't know why Sharon can't hear me.
I cannot hear Pam. Let's watch. No, I will stand off. Thanks.
Let me try this.
Now Pam can't.
I'll
maybe
try that and see if that helps. Does that help?
Yes. Good. Good.
Okay,
it sounds like that helped.
Okay, good. C corporation versus S corp. So a C corporation pays tax at the corporate level. So you could think of it like a closed entity, and it's responsible for its own tax, files its own tax return on which it pays tax. An S corporation is a pass-through entity, like a partnership, where it doesn't pay a corporate level tax except for a small tax to the state of California, but there's no federal tax, and the income flows through to the stockholders and is taxed at the individual level. So as we go through our examples here, you'll see how that comes into play.
So when you said it, the C Corp is taxed at the corporate level, what exactly is that? Is that typically around 35%?
Well, the top rate is 35%, so as soon as you get over $75,000 in corporate income, we're just focusing on federal taxes here, you get up to the 34% bracket, and then over $100,000 you get to the 35% bracket. So it doesn't take much in profit to get to the top bracket.
Okay.
And then for California, there's just, there's a minimum tax, but it's basically a flat tax rate of 8.84%, so you could say 9%. Okay.
And it's typically there's advantages and disadvantages for a C Corp while you're running the business versus once you try to sell it?
Right. So when you're operating, a lot of times it's cheaper, so to speak, to be cheaper tax-wise to be a C Corp because you can, to the extent that you can manage the income by paying bonuses or salaries or paying expenses to get your income below the $75,000 limit, then you can be in a lower bracket like 15% or 25%. Whereas as an S corporation, the income gets transferred through to the shareholder's individual tax return, and probably you're going to be piling it on top of W-2 income and interest and dividends and whatever other income is there, and you'll be in the 35% bracket individually.
Okay. Then you're going to talk later about converting from a C to an S if somebody chooses to?
Yes.
Okay. Can you give us an example of how taxes will be assessed in a C Corp?
So if you go to the next slide there. So I have a little example here. It's a very simple company. They have accounts receivable, inventory, fixed assets. They've got some liabilities, and they've got their stockholders' equity. So in the first column on the left, it says financial statement balances. Those are the book balances that you'd see on their financial statement. So this company's been operating a long time, which is why they have a lot of equity built up in the company. So say that the fair market value is what's showing in the next column under FMV, fair market value, and say a buyer comes along and is willing to buy this company for $6 million.
Okay.
So here I've just allocated what they would be purchasing. So pretty much you could figure accounts receivable is accounts receivable. If there's cash, it's cash. So there's no markup there, so to speak. Inventory typically would be worth, to the extent it's finished goods, it's already built, it's got gross profit that, would be valuable as soon as you turn around and sell it. Fixed assets, these days may or may not be worth what's on the books. Depends on how the company is depreciating their assets. If they're using accelerated depreciation, their book value actually might be really low, but it might not be as much as you think it is. So I've just used kind of a typical example here where the fixed assets are worth a little bit more than the book value.
Okay.
And then at the bottom there I show a line saying goodwill, and I've kind of got that outside the box. And the reason for that is because goodwill's typically not on the books of a company unless they've purchased it. So, this company has been operating by the owner since day one, and he hasn't purchased any goodwill, so it's outside the balance sheet, so to speak.
Right, correct.
So in a corporation then, in a C corporation, what would happen is the corporation has to record the sale of the assets. And in my instance here, they're not taking over the liabilities either. I'm just saying it's a line of credit or something like that, and or maybe it's a loan to the shareholder, who knows. But those are not being purchased by the buyer. So, you have to allocate the sale price to the assets that are being purchased, and so that shows the gain there on the inventory, the gain on the fixed assets, and the goodwill, of course, is all gain because there was no value, no basis to it. So you got a $2 million gain that's now going to be taxed inside the corporation at the corporate rates.
Okay.
So you go to the next slide. So there's a lot of numbers here, but I'll talk you through it real quickly. And so basically it's just to take you through the calculation of, first of all, the gain, and second of all, the cash. So here you're selling the assets for $6 million. The basis in all the assets is $4 million, and the gain is $2 million. So the tax at the maximum rates here are federal 35%, California I rounded up to 9%. So you got $880,000 that the corporation is going to pay from corporate cash, from the $6 million that came in.
Okay.
So you pay the tax. Now you've got $5,120,000 left. So one of the other things I wanted to make sure that everybody is aware of and that you watch out for is, to the extent that you sell fixed assets or tangible assets, which includes your desks, your chairs, your computers, your machinery and equipment, you have to pay sales tax on that to the State Board of Equalization. And that's something that inexperienced buyers and sellers might not realize, number one. And the person that's going to be on the hook for that is the seller, because they're the ones that are supposed to collect the sales tax and pay it over. So if you don't know about it and you're not using experienced advisors, you're going to get stuck with that, in my case, $157,000 of sales tax that you're going to owe to the State Board of Equalization, and you might not have collected it. So it's going to come out of your $6 million. So I've got that here. So then you've got the net cash realized after tax inside the corporation. So you pay off the $1 million of liabilities, so you've got 3.9 left. So now you liquidate the corporation, and say, this guy started a long time ago and he just put $10,000 into the company to start the company. So they're going to have a $3,953,000 gain. That's now going to go to their tax return, and I'm using 2011 rates here. So the 15% rate for 2010 goes away and it becomes 20% in 2011. So you've got 20% federal, 10% California, so you're going to pay $1,186,000 in tax. So from your $6 million, you've got $2,777,000 left. So you've eaten up over 1/3 of your selling price paying taxes.
That probably has C corporations on the line, has their attention, because it can get better, right? One thing, Pam, that I wanted to add, we typically use escrows for the sales of our companies that we list, and the buyers are the ones that are paying the sales tax on the furniture, fixtures, and equipment.
Correct, if it's collected up front.
Right.
But the State Board of Equalization is going to chase after the seller. So if people forget about it and it's not on anybody's radar, see, I've seen it happen where people didn't know about it, and the State Board of Equalization comes calling on the seller because they're the ones that sold the assets.
Aha. Okay. Good.
Yeah.
So we'll have to make sure that the buyers of the business pays that up front.
That's right.
Okay. Okay. Let's see. And then how would you contrast this to the treatment of an S corp?
Okay. So here I'm using the same numbers, and it's an S corporation. And the value is the same, the sale price is the same, so you could see pretty much everything here is the same until you get to the final column here, so where it shows tax rate. And so different assets flow. So on an S corporation, the character of the income flows through to the shareholder, and the same character would be taxed to an individual. And so the inventory is an ordinary asset, and so that gets taxed at ordinary income rates. But fixed assets are taxed at a 25% rate, and you can see below that goodwill is taxed at a capital gains rate of 20%. So there's no tax at the corporate level. So first of all, you've saved the $880,000. But if you see in the box below on the right there, gain taxed at different rates, if you flow all this through on the K-1 to the shareholder, you're going to pay $500,000 on the actual sale of the assets. So, but that's paid at the individual level, so you don't pay it twice.
Okay.
So then if you go to the next slide, we'll walk through the rest of the numbers. So here we're saying your $6 million sales price comes in, you paid your $500,000 of tax, you still got $5.5 million left, you pay your sales tax, you've got $5.34 million left, you pay your liabilities, so you've got $4,343,000 left. Now you liquidate the corporation, and the cash to the stockholder is the $4,343,000, so it's already a bigger number. And then what happens with an S corp is as you're operating all those many years of as an S corporation, your basis is constantly going up and down. So the basis in the shareholder's stock. So they start the company with $10,000, but over the years as they earn income, it adds to the basis, and as they take distributions out, it reduces basis. So for simplicity here, I'm just using the same $3 million that was on the financial statement. It's not going to be the same number, but it's going to be a much bigger number than $10,000.
Okay. So
the gain to the owner here is $1.34 million, and they pay tax on that at the 20% and the 10%. So $403,000 there, and you've got $3.9 million left.
And that was in contrast to
2.777.
And it's really a little more because they typically don't have to pay the sales tax. The buyer will. So it's
right. They would have collected it, so it would have been actually added on to the $6.6 million.
Right. Okay. So if you're an S corporation, you're going to end up with much more cash in your pocket at closing versus a C corp.
Exactly.
If you're selling assets.
That's right.
Okay. So I understand that you can change from a C corp to an S corp, but my understanding was that you had to allow 10 years in order to be treated, have the treatment of an S corp at closing. Can you go into some detail about the new Small Business Jobs Act that might have changed that?
Sure. And there was a little bit of a provision there in the Small Business Jobs Act that just passed at the end of September. Unfortunately, it's not a prospective change. It's allowing relief for a few companies, but it's not going to be relief for those that are C corporations today. So the deal that they passed was said they're reducing the built-in gain period from 10 years to 5 years. But it's only if the 5th tax year precedes the tax year beginning in 2011. So that would have to be 2010. And that means they would have had to made an S election in 2006 or earlier. Okay. So for companies that are in their 5th, 6th, 7th, 8th year as an S Corp, they've got relief here. But if you're a C Corp today and you want to make an S election, you're going to have to wait the 10 years.
Okay.
Okay.
So I wonder why some CPAs have recommended to their clients to become C Corps versus S. What would be some of the reasons that people do become C Corps versus S if the advantages are so strong when you sell?
Well, a lot of times there's not a lot known about what an owner wants to do in the future. So sometimes you might ask them up front, are you going to sell this company? And they say, no, I'm not going to sell it. I'm going to work here forever. Or a lot of them have been incorporated forever and they buy the corporation, and maybe they actually did buy the stock. Mm-hmm. And so they step into the shoes of the previous stockholder. Others, I think it's just inexperience. They don't understand they've only worked with C corporations and they don't understand an S Corp. So that happens quite a bit.
Okay. So buyers also and sellers have the option of selling stock versus assets. And I know many sellers would prefer doing that. Could you touch on why buyers don't typically want to do it? You may have already touched on that.
Why they would want to?
Why they would not want it to be a stock sale. They prefer an asset sale.
Well,
liabilities.
Yeah, I mean, they don't want to take on the unknown liabilities. That's usually the biggest reason.
And then
the second reason is, they want to be able to deduct as much of the sale price as possible.
Right.
Yeah.
And if it heavily has a lot of capital equipment, they have to step in the shoes of the seller. So if it's already been depreciated, they don't get to take that depreciation, correct?
Exactly.
Okay. So that's another good reason.
Mm-hmm.
Well, those were some really good points. Now, do you have any good ideas for tax, any techniques that the sellers could be utilizing other than the S Corp versus C?
Yeah, so, the number one tax savings technique, if you've got a 10-year window here, go ahead and make an S election. I would still recommend it at this point in time. If you want to be working for a while and you're trying to come out of this last recession and you want to build up the value of the company, now is a good time to make an S election. It's a little bit like insurance. You don't really know when the right deal might come along, and so better to at least position yourself that you could take advantage of that if and when it happens.
Okay.
So then when you're doing a deal, you want to allocate your sales price first to the current assets. So the reason I say that is because those things have basis typically. For example, the examples I showed were accounts receivable. You're pretty much going to allocate that on a dollar-for-dollar basis. But inventory, you want to allocate, even though it's taxed at a higher rate if you're an S Corp, you still have all that basis there, so it reduces your gain. So to the extent you can allocate it to assets that have basis, that's where you want to allocate it. So inventory, if you have prepaids, of course, they're going to be dollar for dollar, and then fixed assets to the extent you can. And then the next thing is going to be customer lists and goodwill and all the other intangible assets. Okay.
And then let's look at a sample of one that I had, an allocation form of the $821,387 purchase price. this has to be agreed upon by buyer and seller before closing, correct, Pam?
Absolutely right. I mean, I have seen them where they didn't do it, and it really makes it a challenge for the CPAs preparing both of the tax returns, because there's a form that needs to be filed with the first tax return after the sale saying how the sales price was allocated, and theoretically they would agree on both the buyer and seller's tax returns.
So it's all for tax purposes, this allocation?
Right. It's basically to document the basis going forward, especially for the buyer, so that they have this agreement that, yes, I can depreciate the furniture and fixtures and the leasehold improvements and the goodwill.
Okay. So what would be the advantage or disadvantage of furniture, fixture, and equipment for them putting $60K of that? It's, not a big portion of it, but how is that treated?
Well, for furniture, fixtures, and equipment, usually you're going to have a shorter life for 5 to 7 years for most of that stuff. Leasehold improvements, might be a little bit longer life. The life of the lease or land improvements are 10 years. And then goodwill, you're going to have to amortize, and the law says, it's 15-year property, so there's no movement on that. There's no way to change it. So it's a much longer recovery period for the buyer. For the buyer of your money.
But the seller loves to have as much as possible in goodwill because of the treatment of capital gains on a tax versus ordinary income?
That's right.
Mm-hmm. Okay. Now this one you can see in K, accounts receivable. They were not buying the accounts receivable, which is often the case. And then so the inventory, that is basically what it is, right?
Mm-hmm.
Count that at closing.
Right.
And so this just gives you an idea. And Pam, sometimes this is handled as part of the asset purchase agreement, is included, and what's your feeling on that?
Well, it's very nice. I mean, if they're working with somebody like you, I know you present that with for people and make sure that it happens. But I mean, I've seen it where it doesn't get spelled out, and it's just messy,
Right.
and you don't know what the buyer is. If you're the seller, you're not really sure what the buyer is reporting, because by the time you're filing the tax return, you're probably not in communication with them.
Okay.
So.
And what this is typically a negotiable item. What's good for the sellers is typically not good for the buyer.
That's right. Yep. Which brings us to point number 7 there: start planning early and involve your advisors. And so, you and I, of course, and the attorney can never stress enough to get your advisors involved early. At least get to have an educational conversation, if nothing else, even if there's no deal in the immediate future. I mean, it's better to talk 3 years ahead and say, just get some ideas about what do I need to watch out for, and what's important today. What should I be doing the next 2 or 3 years to build the value of the company and, get some of the skeletons in the closet maybe out of the way.
Mm-hmm.
So you can have you put your best foot forward.
Okay. And valuations, those are typically the first place to start?
Well, you need to know where you're starting from, right? So to the extent you can get a valuation, again, if you're going about this in a methodical manner and thinking ahead and planning and strategizing for the best result for you, yourself, the seller, then the more information you have, the better. So a lot of business owners think, well, for this industry there's a rule of thumb, or, I think my business is worth this, or I'm going to sell it at this value. Well, you don't even know what that kind of a business looks like, perhaps. And so better to get some outside third-party expert advice early on so you can, avoid surprises and know where you're starting from.
Right.
And then you know what you need to do to, it's like, okay, if I want to sell at $40 million and I'm at $15 million, what do I need to do to make this company look like a $40 million company? What infrastructure does it need? What revenues do do I need to be at? What kind of a gross profit? That type of analysis.
And we found so frequently when a seller does work with us to help get a formal valuation done, they thought many times that they were going to have to work another 3 to 5 years, and then they saw the value and they realized they could do it right now. And then, of course, the opposite happens, where they realize, gee, I thought I could get that now. It looks like I have a couple more years to go. So, yeah, so it is the first place to start to get your baseline.
Right.
Definitely agree.
And then sometimes it's good to have your CPA do a what-if calculation. And the reason I bring that up is because of especially if you're an S corporation, there are the different tax rates. And so a lot of times it's hard to get your arms around the result unless you actually crunch the numbers. So, if you take your balance sheet today and say, let's say I were able to sell it at this, what would it cost me in taxes? And then, you can kind of set your expectations for what you're going to want to look for in a sales price.
Okay. And just to jump back to the allocation, if it's a stock sale and not an asset sale, how is allocation treated?
Well, if it's stock sale, basically the buyer steps into the shoes of the seller stockholder and the balance sheet doesn't change at all. So they just take the company the way it was and keep going.
Good. Okay. Okay. Let's go to the next one. This is mine. Okay. So the ultimate financial goal for a seller, of course, is to maximize the amount of money in your pocket are paid. So I think you all are hearing plan, 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 and strategize. And that long-term tax planning is definitely going to maximize the profits of your business sale. You definitely need to consult with the tax professional before the deal's in motion. Sad story happened, 8 years ago. I was working with a seller, and it was going so well. The whole time I was saying, you've talked to your CPA, right, about how this is going to affect you tax-wise? And he goes, that's not a problem. It's not a problem. And probably 12 months into it, we were negotiating. He had 3 solid offers for the price that he wanted, but just different structures. And he said, I think I'd better talk to my CPA to see how this is going to affect me. And his CPA said, oh, my goodness, you're going to be affected. You're going to get hit pretty hard on taxes. You probably shouldn't sell now. And, of course, the CPA wasn't taking into account his motivation, why he wanted to move on in the first place, what he was going to do after that. He was just looking at the taxes. But it would have saved all of us a lot of pain and suffering if he had done this earlier in the game. And he looks back. In hindsight, I just spoke with him a few months ago, and he's saying, boy, I could kick myself for not selling back then because, of course, his numbers changed during the recession. So that was pretty sad. And so definitely utilize the expertise of a professional versed in tax consequences surrounding the sale. Your CPA, you should definitely ask them, have you been involved in transactions? Have you done deals? And have you helped in the process? Because I think that's a big difference. I have a very good CPA that can help me with my personal taxes and maybe my business taxes, but they've never really, let's say they haven't been involved in a transaction, and so you might even have to change for that particular transaction. So definitely do your due diligence on your business transfer professional. Ask them for references. Definitely, I can give you a list of questions to when we talk that you should be finding out about them, and you want to talk to people and say, were they pleased with how the transaction went? Did you get the best tax treatment that you had hoped for? And then I think you'll be pleased with the results.
And Joan, you work with a lot of business valuation people as well that you could refer, right?
Yes, we do. Yeah. Thanks, Pam. We work with 2 or 3 companies that's all they do. They're accredited. They've been approved by banks if you are getting SBA lending. So, yes, I can refer you to valuation companies. We have some questions from our group today. Let's see the first one. if the payout is over several years, probably it's an earn-out depending on the performance of the business, Pam, or it could just be a note also. And let's say, but it begins in 2010. Do you get to treat the whole purchase at the 2010 rate or as you get it?
Well, that's a great question because most people would prefer to report on an installment sale, but maybe this year you would rather report it all at once. You do have the option of reporting it early at the date of sale, but if it is an installment sale, then you can make an election to treat it as an installment sale. So this is maybe one of the few times I've seen where you might want to accelerate the tax treatment and pick it up all at once.
But if it's an earn-out, I understand if it's a note, but if it's an earn-out?
Oh, if it's an earn-out where they're getting paid maybe as a consulting agreement or based on milestones. That
could be recognized early, even if you're not sure whether you'll earn it or not?
Yeah, I mean, if you, to the extent, I think that the result would have to be known. So it's an if this, then that. It might be kind of hard to pick that up.
Okay. Somebody asked us to explain what an earn-out is. Would you like to take that, or would you like me to? Or?
You can do it. You've dealt with a lot of those.
Hey, Eric, you're on here. Why don't you take it?
Okay. Hello, everybody. This is Eric Nielsen.
Eric Nielsen.
And an earn-out is typically a promise for a future payment based on some performance metrics that the buyer and seller agree on going forward in the future. And just to give you an idea, a really common type of earn-out may be based on reaching some sales volumes that the seller is promising that are going to come to reality, and the buyer may be skeptical or unsure. And so a typical situation may be if X amount of sales are reached or above, there may be a formula that says that the seller would receive additional monies above and beyond the sales price. And if that comes to pass, then the formula goes into place, and the buyer will pay the additional price to the seller.
Okay,
well,
thank you, Eric.
Very simple model. There's the variations are unlimited based on creativity of the buyer and the seller and the transaction deal team. So,
is it typically based on revenue versus profit?
Most often, it's based on revenues. The problems with basing them on profit often revolve around how is that profit calculated. Who's managing the business, and what control do they have over over the profit, and how are they reporting it? So it can often be a challenge to come to an agreement that's based on profitability, and more often we'll see them based on revenues or other performance metrics.
Okay, thank you, Eric. Pam, one of the questions that I definitely wanted us to touch on too is treating part of the acquisition as personal goodwill. Founder. Does this create a characterization of income problem if part of the sales price is allocated to a non-compete covenant?
So that's something where you'd want to it's part of the allocation in the purchase price. So to the extent that the founder, if it's a personal service corporation, for example, like a law firm or a dentist or doctor, or where the CPA, where the services are rendered by the person with a license, for example, and it could even happen where the owner has such great contacts and networks, that's what provided a lot of the sales for the company. To the extent that those services or the value could be attached to his personal efforts, then that portion of the sales price should be allocated to the goodwill of him as a person, and it would be outside the corporation. So in the case of a C Corp, for example, that part of the payment should go to the person and not to the corporation. So that way he would get capital gain treatment on it because he would report it. He would be selling it himself. and the corporation is not actually selling.
That way if it's a C Corp, Pam?
Right, right. If it's an S Corp, I mean, it's less of an issue because the corporation doesn't pay tax anyway. It would flow through to him as capital gains anyway. So it's less of a logistical issue as far as the allocation of the purchase price to the individual.
Okay. And then there was a question, sales tax on furniture fixtures. Is there a sales tax? I don't believe there is on leasehold improvements. I think it's just FF&E, correct?
Yeah, it's got to be tangible personal property. So it would have, if it's attached to the building, it starts becoming real property.
Okay.
So they're going to pay real estate tax on it rather than, somebody's paying real estate tax on it rather than sales tax.
Right. Okay. There was a question on wanting us to comment on how the market is for small business right now, improving, how's financing. I could address that.
Yeah, that would be
Eric,
great.
Add something too. We're seeing the I would say we're seeing the end of the tunnel, light at the end of the tunnel. It's looking better. However, banks are still pretty conservative. Where they would have lended on a business 3 years ago, now they may say you have to have industry experience. They may say that you definitely do have to have capital to collateralize it with, or property to collateralize your loan with. But I would say the market is looking better. Buyers are still a little squeamish, a little conservative in moving forward. Things are taking longer. Eric, how would you describe it?
Well, I think if you're looking at the market, at the extrinsic value of companies, we're definitely in a kind of a trough in the cycle. So, all things being equal for businesses out there with regards to their financial performance and industry attractiveness, the multiples are down and the prices are down a little bit. And so buyers, in many cases, we're getting a couple deals right now where strategic buyers are taking advantage of this, and are going out to grow their businesses by making strategic buys within their industry to build their sales revenues and build their businesses.
Mm-hmm. We are seeing that numbers the second half of 2010 for many of the companies are looking better. So once they have a solid 12 months of it being solid and some growth, I think they're going to be able to garner more for their business. So I want to thank everybody so much for coming today. You can see the information for the presenters. Pam, if you have any questions for Pam that were not able to be answered, please feel free to get her. And if there's any question that you'd like to look back on or look at that slide again, within 24 hours, our webinar will be posted on the sunbeltbayarea.net webpage. So we will send that out to everybody to make sure you can look at it again or refer it to anybody that may have interest. And next month we will be having a new webinar, so keep your emails, your eyes open, and we'll be posting that to you and letting you know. So thanks so much for coming, and I hope you're able to take some good information away from you. Thanks so much, Pam, for all your help.
Absolutely.
Okay. Have a good day. Bye-bye.
Bye.
Thank you. Please stand by.